The Nikkei just closed down 0.49%. A headline says Japan stocks lower. And right now every single piece of news flow is whispering that the Bank of Japan is about to tighten. But here is the fact no one is screaming about. The monthly trend is a strong buy. The weekly trend is a strong buy. The daily, the 4-hour, the 60-minute, or every single one of them is flagged as a strong buy. This pullback is not a breakdown. It is a trap. And inside that trap, there is one danger zone and one hidden opportunity that I am going to show you right now. Stay until the end because I am handing you 3 exact levels you can trade tomorrow, sniper precise, with stops and targets, nothing left to guess. For tomorrow's session, my instant market verdict is this: the Nikkei is coiling in a range with an upside breakout tilt, but only above 67,505. Until that level breaks, we fade the intraday exhaustion back toward the first structural floor. The single invalidation number that flips the entire bias, write this down, is 66,519. If we get a 4-hour candle close below 66,519, the whole bullish structure resets, and we are targeting 65,888 next, then 65,532. That is your line in the sand. Now here is the micro insight that gives you an edge. The herd is overwhelmingly long Nikkei futures, positioning for a breakout, but exchange-traded fund flow data shows the smart money has been peeling off exposure into strength. They have built a liquidity pool right above 67,500. If that wall holds and the BOJ narrative spikes, those trapped longs become the gasoline for a liquidation cascade. The crowd is leaning the wrong way, and the market always hunts the crowded side. Let's walk the charts from the top down, because the macro picture tells you exactly where the alpha lives. On the weekly time frame, the Nikkei has been a monster. The 50-week moving average is sitting at 61,232. Every single dip toward that level this year has been bought with institutional aggression. It is the trend engine. The 200-week moving average is way down at 53,899. That is the basement of a secular bull market that is still intact. Weekly MACD is expanding. There is not one whisper of negative divergence on the weekly. So strategically, you stay with the trend until you are given a reason to step aside. Now drop to the daily. The 20-day moving average is at 63,922. Price has not even come close to testing it. That 20-day MA is the trampoline that has bounced the Nikkei higher relentlessly. The 10-day moving average is at 65,340. That is the short-term momentum line, and we are holding above it easily. The 50-day MA at 61,232 is climbing steeply, and the 100-day MA at 58,150 is about to cross above the 200-day at 53,899. That is a massive golden cross that the market has not even fully priced yet. The daily RSI is at 69.5. It is not overbought, but it is kissing the ceiling where rallies normally pause and let the moving averages catch up. Daily MACD prints 1,981 and is still positive. So the daily structure is pristine, but it is stretched, the rubber band is tight, and that tightness is exactly why a short-term shakeout is the highest probability move. Now, here is what most traders miss. Shift to the 4-hour chart. This is where the immediate battle will be won or lost. Look at the MACD histogram. Price made a higher high near 67,500 earlier this week, but the MACD histogram is tapering. It is making lower highs. That is a textbook 4-hour negative divergence. Buyers are exhausted. The smart money is not buying the new high. They are selling into it. The 20-period moving average on the 4-hour is sloping up around 66,500, acting as dynamic support, but the candles are wobbling all around it. The 60-period moving average on the 4-hour is roughly at 66,200. If we lose that, the floor drops open to 66,500. 19 daily support, and that is the trapdoor. On the 60-minute chart, the Nikkei is carving out a tiny descending channel from today's high. The 200-period moving average on the 60-minute is providing a floor near 66,200 as well, but the 40-period is capping any bounce. That microchannel is the fuse. It is tight, it is coiling, and it is going to explode one direction within the next 2 sessions. The hidden divergence is not just on the Nikkei index. It is flashing on the Topix banking index too. Bank stocks are getting crushed on rate hike fears, because higher rates squeeze their margins before they reprice loans. If the Topix banks break their own trendline, they will drag the Nikkei through 66,519 like a hot knife through butter. Cross-asset linkage is absolutely critical right now. Normally, a weaker yen fuels the Nikkei, but today the yen strengthened and the Nikkei only dipped modestly. Why? Because US tech futures stayed bid overnight. NVIDIA held up, and the S&P futures refused to crack. That decoupling is a warning. If US futures roll over tonight, the Nikkei will play catch-up to the downside violently, because it will lose the only thing holding it up. The cross-correlation with the S&P 500 and Bitcoin is tightening. Japan's rate hike article, Why Japan's Rate Hike Could Hit Crypto and NVIDIA at Once, is not clickbait. It is the connective tissue. A hawkish BOJ lifts the yen, which unwinds the carry trade that has juiced Bitcoin longs and tech megacaps. So when you trade the Nikkei, you are trading the entire risk asset complex. Key support levels are crystal clear. 66,519 is the first wall. Below that, 65,888, and the brick support at 65,532. On the resistance side, 67,505 is the immediate ceiling. Beyond that, 67,861, and the massive breakout level at 68,492. Write these numbers on your screen. They are your grid for tomorrow. Yesterday's core news changed the volatility landscape. Japan's finance minister made a subtle comment overnight that the BOJ may need to address yen weakness sooner rather than later. That single headline sent the yen surging, and Nikkei futures dropped before the Tokyo Open. The article circulating, Why Japan's Rate Hike Could Hit Crypto and NVIDIA at Once, perfectly captures the spillover. If the BOJ turns hawkish, the yen carry trade that has been pumping liquidity into risk assets begins to unwind. That hits not just the Nikkei but also US tech and Bitcoin simultaneously. The Nikkei becomes the shockwave epicenter. Policy divergence is the engine. The Fed is on hold, but the BOJ is inching toward a tightening move that the market has never fully priced. The 10-year JGB yield has climbed to 1.2%, and that quietly compresses equity multiples. ETF flows into Japan have been positive for 5 consecutive weeks. Institutional money is still rotating in, but those flows can reverse in a heartbeat if a rate hike becomes a live meeting-by-meeting risk. For the next 1 to 2 weeks, my directional lean is bullish. The trend is a freight train, and you do not step in front of it without a confirmed break. However, the exact event that invalidates that view is an unscheduled BOJ announcement or an emergency meeting that signals immediate tightening. If that hits, 65,532 becomes the magnet. Do you think the Nikkei breaks 67,500 this week? Comment yes or no right now. I am tracking your consensus against the institutional order flow. Most people skip this section. That is exactly where the money is made. Keep watching, because I am giving you 3 precise battle plans, each with the trigger, the stop, the targets, and the exact invalidation that keeps you safe. Strategy 1, the sniper. This is the conservative play, only for those who want to ride the breakout after the market proves it. The entry trigger is a 4-hour candle close above 67,505. That confirms the bulls have absorbed every sell order at resistance. Stop loss goes at 66,900, tucked right below the 4-hour demand zone and beneath the 20-period moving average. Take profit 1 is 67,861, the next resistance cluster, giving a risk-reward of 1 to 2. Take profit 2 is 68,492, the major breakout zone, stretching to 1 to 4.5 R. This setup is completely void if we see a daily close below 66,519 before the breakout. That would signal the bears have taken control, and we stand aside the sniper, conservative, entry, 67,505, for H close above, stop loss, 66,900. Take profit 1, 67,861 take profit 2, 68,492 risk. Reward, 1:2R 1:4.5R invalidation. Void if daily close below 66,519 strategy 2, the active trader. This is for those who want to trade the pullback within the trend. We buy the dip at 66,519. The entry condition is a bullish engulfing 1-hour candle or an RSI bounce from oversold on the 60-minute chart right at that level. Place your stop at 66,350, just beneath the zone, because if 66,519 breaks, the next support is 65,888 and we do not want to be caught in that slide. First target is 67,200, reclaiming the intraday breakdown level. Once target 1 is hit, immediately trail your stop to break even and let the position run to target 2 at 67,500. This offers a risk reward of 1 to 2.4. Invalidation, if price slices through 66,519. Without any bounce and prints a 1-hour close below, the trade is off. Do not force it. Active trader, standard, entry, 66,519, bullish 1H engulfing RSI bounce, stop loss, 66,350 take profit 1, 67,200 take profit 2, 67,500 trailing stop, to break even after TP1 invalidation. Void if 1H close below 66,519. Type your Nikkei range for tomorrow in the comments now. Give me your high and your low. Let's see who is aligned with the real order flow strategy 3, the aggressor. This is high risk, for traders who can stomach tight stops and counter-trend scalps. If the Nikkei fails to clear 67,505 and prints a bearish engulfing 4-hour candle, with RSI rolling over from near 70, you sell at market at the close of that candle, somewhere around 67,300. Stop loss is razor thin at 67,550, just above the swing high. Target 1 is 66,900. Target 2 is 66,519. This gives a risk reward of 1 to 1.6 on the first target, extending to 1 to 3 on the second. But listen carefully. If the market opens gap up above 67,505, this setup is instantly void. Only take it if you can lose small and move fast. This is not for wide stops and hoping. This is surgical, the aggressor, high risk, entry, 67,300, 4H bearish engulfing, RSI rollover, stop loss, 67,550 take profit 1, 66,900 take profit 2, 66,519 risk, reward, 1 minute and 1.6 seconds. 1:3 invalidation. Void if open above 67,505. Never risk more than 1 to 2% of your account on any single trade. Do not hold positions through high-impact news like BOJ speak or US ISM prints. Stops are non-negotiable. This is how you survive the traps and live to trade the next explosive move. Let's lock in a plan. For tomorrow, the single most critical level is 66,519. If we hold above it, the bulls are in control, and the melt-up towards 68,492 is still live. A break below, and we are staring at a freefall into 65,888, and likely 65,532. Tomorrow's wildcard is the US ISM Services PMI and any unscheduled BOJ commentary. These will either light the fuse or douse it. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Tap the end screen right there. Smash the like button if this gave you a clear, tradable plan. Subscribe, hit the bell, and I will see you in the next one, before the move happens.